Hello, fellow compounders. Welcome back. Would you like to earn $20,000 per year in dividends? In this video, I'll show you how. By investing in a dividend growth portfolio with determination and patience. This video is for educational purposes only and should not be considered financial advice. I am not your financial advisor and you are responsible for your own financial decisions. Let's say that we'd like to create a dividend growth portfolio that will deliver income in the form of dividends in the next 10 years. To do so, we start with a plan. We'll need to answer the following 6 questions. Number 1, what's the objective or what's the goal? 2, what's your time frame? 3, what is the dividend rate of the portfolio? 4, what is the dividend growth rate of the portfolio? 5, what are the investments? What are we going to be investing in? And 6, how much are we going to be investing in the portfolio? So let's take the investment case of William. William is a software engineer who has done quite well financially in his 25-year career at Apple. He's planning to retire in the next 10 years. He's a family man and has a wife and 2 daughters. William also has 2 younger siblings, Doris, who is 2 years younger, and Peter, who is 5 years younger. Doris is a scriptwriter for fantasy and sci-fi shows, like Game of Thrones and Star Trek Picard. Peter is a Catholic priest who has given a vow of poverty and is doing missionary work in the Amazon basin in Brazil. William and Doris care a lot for their younger brother and have been donating to Peter's ministry over the years and help him financially. William and Doris would like to set up a small family endowment to continue supporting Peter for the rest of his life, even after William and Doris have retired. Therefore, I've suggested building a dividend growth portfolio over the next 10 years. The goal is to provide a constant stream of income to give to Peter after Doris and William have retired. Here's what we know. Number 1, what's the objective? They want a portfolio that can deliver $20,000 of dividends per year. Number 2, time frame. The portfolio is to be built over 10 years. This means that at the end of 10 years, Doris and William will stop contributing to the fund and the fund should be self-sufficient. Number 3, what is the initial dividend rate of the investments? This is the initial yield of the investment that enter the fund. We'd like to have a yield between 3 to 5%. We'll use a target of 4% in the model. Number 4, what's the dividend growth rate? This is the rate at which we expect the dividends to grow. We would like a double-digit rate. Let's use 15% in our model. Number 5, what will the fund invest in? Let's say that we can find investments with the parameters that we defined above. Every year, we would add positions that fit those parameters. This year, we will start by investing in Brookfield Asset Management, which fits all the parameters. And number 6, how much money would Doris and William need to contribute? This is the variable that we will solve in this example. As it turns out, once we see the example, is that they would need to invest around $20,000 per year or $10,000 each. Of course, if the variables change, they will have to make some adjustments along the way. Before we go to the model, let's review Brookfield Asset Management, ticker BAM, BAM. It's one of the investments that I'm suggesting for this dividend growth endowment. We spoke about its parent company, Brookfield Corporation, in this video. BAM was just spun off from Brookfield Corporation last year, but Brookfield Corporation still owns 75% of BAM. The other 25% is what's publicly traded. Brookfield Asset Management provides alternative asset management services. It's one of the largest and fastest growing alternative asset managers in the world. It has operations in 30 countries on 5 continents. It has around $800 billion, that's billion with a B, of assets under management. Even though it just went public, it's been in business for more than 25 years. Brookfield Asset Management is the brains of Brookfield Corporation. If Brookfield Corporation were Berkshire Hathaway, which we all know, Brookfield Asset Management would be Warren Buffett and Charlie Munger. Owning BAM is as if you could have spun off Buffett and Mungers from Berkshire Hathaway and created a Buffett and Munger investment management company and charge fees for their services. So that's what we're getting with BAM. BAM is the investor or the manager of the investments of Brookfield Corporation. So BAM recently declared a 32 cents dividend, quarterly dividend per share, and the management expects the dividend to grow at a 15 to 20% compound annual growth rate. The business currently generates over $2 billion in distributable earnings, and they expect it to at least double over the next 5 years. BAM's strengths are: 1. The cash flow stream is extremely resilient. Most of their $418 billion of fee-bearing capital is invested in long-term private funds that have perpetual or 10-plus year lives. Number 2, distributable earnings are almost entirely made up of stable and annuity-like fee-related earnings. They are simple to understand, stable, and easy to predict. Number 3, they plan on returning most of their cash flow to shareholders via dividends and, if it makes sense, through stock buybacks. Currently, they're distributing back 90% of their earnings. 4, they have a strong balance sheet with no debt and $3 billion in cash and financial assets. 5, they are highly diversified. This enables them to deploy capital throughout economic cycles in their investment segments, which are credit, private equity, and real estate businesses. Brookfield Asset Management will be the first investment for the fund. And in the following years, Doris and William will continue adding other stocks with similar characteristics to the portfolio. This means adding other investments with around 4% dividend yield and a dividend growth rate of around 15%. Now, let's go to the spreadsheet to review our projected results. Now, let's look at our model. We're assuming that we're using Brookfield Asset Management throughout the 10 years, but that's not true. I mean, what they're going to do is that every year they're going to look for similar investments and we'll be buying $20,000 per year. But let's just use Brookfield Asset Management as the placeholder here so we can see how it would work out over the 10 years. So we have that Brookfield Asset Management as of April 6, 2023 is trading at $31.62, and it's paying a dividend. The next 12 months will be receiving a dividend of $1.28 in the year. So that's 32 cents by 4 quarters. That gives us a dividend rate of around 4%. And we know that they're estimating a dividend growth rate between 15 to 20%. We're going to use 15% here. So the first year, those $20,000 will be receiving or paying out $810. And we'll compound it. We'll reinvest those dividends until we get to year 10. So year 2 will add another $20,000. And plus we get $40,000, which are the $20,000 from the year before, plus the new $20,000, plus the $810 that we're compounding from the dividends received. So when we extend all this out, by year 10, the dividends that you'll be receiving in year 10 is $20,052, which, if you looked at the yield on cost of the average of the $200,000 that they would have contributed, it will give you a 7.63% yield on average cost. Not bad for an endowment that's starting out with a 4% dividend yield. So, of course, some of you would argue or could argue that this is a risky portfolio because it isn't diversified. But remember, this is only true at the start because each year there will be new positions. So after 10 years, there will be at least 10 different positions. Every year you'll be adding another position or positions that fit the parameters. So as they approach the end of the funding phase, the portfolio would be diversified. However, if you don't feel comfortable by doing one position a year, another way to do it would be to use an ETF. This would provide diversification instantly. An ETF, or exchange traded fund, is a basket of stocks. I would suggest using Schwab US Dividend Equity ETF, symbol SCHD. However, the difference is that SCHD's yield is lower than BAM's, which is 3.6%, versus BAM's, which is around 4%. And the annual dividend growth rate is 11.7% versus BAM's estimated at 15%. But SCHD is a solid choice. So let's see how SCHD would do. So let's go over here at SCHD. Let me just verify what I just told you. See, here's SCHD. It's paying a $2.64 annual dividend, and their yield currently is around 3.6%. If we go over to dividends, we can see their estimated growth rate, or actually their historical growth rate for the past 10 years was 11.72%. Currently, the last year it grew at 16.6%. So we're going to use the 10-year rate since we're looking at a 10-year period. So let's go to our Excel, back to our Excel. And so here we see that we're using $73 per share for Schwab, 2.6 for $2.64 dividend, annual dividend growth of 11.72%. And if we just do purely Schwab, given that it's diversified, and don't worry about choosing any other stock, this is what we would have. So if they invested $20,000 per year, at the end of 10 years, the dividend will be $14,929, almost $15,000. If you wanted to get to the $20,000 annual dividend, then you would extend, or you would have to wait for it to grow 2 more years and compounding the dividends to get to $19,859 at year 12. The other thing you could do is increase the contributions. Let's just quickly do it. We'll do a scenario seek here. What if we'll go seek, we want this to be $20,000 at year 10 by changing your contribution. Okay, so here we go. To get $20,000 in annual dividends at year 10, you would need, or they would need to contribute $26,794 per year if they decided to go with the Schwab ETF and just stick to that. So there you have it. They could either go start building out the fund, adding one investment per year, or they could just go using an ETF, well-diversified portfolio from the start, and you either contribute more money, which is $26,794, or extend the life of the fund before they start releasing funds by 2 more years. One last thing. Once the endowment for Peter is fully funded and it's distributing $20,000 per year, you have to remember that the distribution, this $20,000, can be adjusted for inflation because the dividends are growing. And the dividends are growing at a rate faster than inflation. Well, we're assuming inflation is around 3%. So if that's the case, this $20,000 per year that the endowment is giving Peter can be adjusted for inflation. So there you have it, a dividend growth portfolio that produces $20,000 of dividends per year. You can apply it to your own scenario. Thank you for watching, and remember, always be compounding. Take care.